Welcome back to Investing Talk Podcast. Today, we're looking closely at the United States Natural Gas Fund, LP, ticker UNG. We've heard some curiosity about this one. You might be wondering, is it just a straightforward way to bet on natural gas, or is there, more going on under the hood? So our plan today is to unpack what UNG is all about using the reports we have and see what really stands out.
Okay, so first off, what is UNG fundamentally? It started back in September 2006. It's set up as a commodity pool.
A commodity pool, so like a pooled investment, but for commodities, not stocks.
Basically, yes.
Yeah.
It lets investors get into the commodity markets.
Yeah.
And its primary goal, looking at the filings, is to give exposure to the price movements of specifically the front-month natural gas futures contracts, the ones on the NYMEX.
Front-month future. Okay, so it's not actually buying and holding tanks of natural gas somewhere.
No, nothing like that. It's all done through these futures contracts.
And to keep that focus on the near term, the front month, it has to keep rolling contracts, right? Selling the one that's about to expire and buying the next month.
That's the mechanism. It achieves its goal by rolling expiring contracts to the next available month. And importantly for investors, it's listed on the NYSE ARCA, so you get that liquidity, relatively easy buying and selling.
Got it. So this constant rolling, that sounds like it could have implications. Let's talk financials. The reports mention, 111% revenue growth recently? That sounds huge.
It does, but, well, this is where things get a bit different for a fund like UNG. That revenue figure, while accurate from an accounting perspective maybe, isn't really the best indicator of, underlying business health in the way it would be for a normal company. It's more a reflection of the value changes in the futures it holds.
Right, because it's tracking futures, not selling widgets. So that big number might not mean what you think it means at first glance.
Precisely. And the same goes for net income. For March 2025, the reports show about $27.2 million in net income. That reflects gains from its natural gas futures positions during that period.
Okay, so it made money on paper from the contracts, but then what about things like a PE ratio? The report mentions 18.52.
Yeah, that PE ratio is kind of unusual for a commodity fund. It likely reflects the valuation of those derivative contracts rather than traditional earnings from operations. So you really can't compare UNG's PE directly to, say, a tech company or a manufacturer. It's just not apples to apples.
So it's almost a misleading metric in this context.
It can be if you're not aware of what's behind it. Similarly, things like debt to equity, free cash flow, they don't really apply here.
Because it doesn't have typical debt or operational cash flow.
Correct. It's primarily dealing with futures contracts and reinvesting proceeds to maintain those positions. Even ROE, return on equity, isn't applicable. It doesn't have traditional equity or retained earnings in the same way a corporation does.
Okay, so if those standard metrics are out, how do you assess its financial health? What should you look at?
The key thing is its net asset value, the NAV. You assess UNG's health by looking at its NAV and comparing that to its market price. Is it trading at a premium or a discount to the value of its underlying assets, which are those futures contracts?
Right, the NAV. That makes sense. Let's shift gears then to what actually drives its performance. What makes UNG's price move?
Well, it doesn't have traditional competitive advantages, like patents or a unique brand in the usual sense. Where it competes is partly on cost. Its management fee is relatively low for this kind of product, somewhere between 0.50% and 0.60%.
Low fees are good, but if the structure itself has built-in costs, like from that rolling process we mentioned.
That's a very important point to consider, yes. The fee is just one part of the total cost picture. In terms of market position, it is the market leader among the pure-play natural gas ETFs, just looking at assets under management, or AUM. It's around $379 million.
Okay, leader in its specific niche, but that's still quite a bit smaller than, say, broad energy sector ETFs, right, like XLE.
Oh, much smaller. XLE is in the tens of billions. And crucially, UNG's performance is massively influenced by the volatility of natural gas prices themselves.
And those prices are driven by, what? Weather, obviously. Definitely weather. Big driver. Also, things like the demand for liquefied natural gas, LNG exports are increasingly important. And then there's the longer-term potential impact of, how quickly renewable energy gets adopted and how that affects natural gas demand down the line.
Lots of moving parts. What about the management? Who's running the show?
It's managed by a company called USCF Investments. The specific executive names aren't usually detailed in these kinds of fund filings. They've been operating UNG since 2007, and they've consistently used that standard roll strategy for the futures contracts. It's a known quantity in that sense.
Any red flags like insider trading showing up?
The reports we looked at don't show any recent insider trading activity. SEC filings for funds like this tend to focus more on the portfolio holdings, the contracts it owns.
Okay, so back to valuation or lack thereof in the traditional sense, price to book.
Also not relevant, really, because of that NAV-based structure. It's valued based on the assets it holds.
And dividends. Does it pay any? No, UNG doesn't distribute dividends. Any return for an investor comes purely from changes in the share price itself.
Which, as we said, is tied to volatile natural gas prices, so high beta is probably a given.
Very likely, yes. It reflects that inherent volatility. But the really big risk, the one that comes up again and again with these types of futures funds, is contango.
Right. Explain contango again. How does that actually hurt an investor in UNG?
Okay, so contango is when the futures price for delivering natural gas, say 3 months from now, is higher than the price for delivering it next month. Since UNG has to constantly roll its contracts, sell the expiring near-month contract, and buy the next one out if that next contract is more expensive just because it's further in the future.
It's consistently selling low and buying high, in a sense.
That's a good way to put it. It creates this drag on returns. Even if the spot price of natural gas, the price for immediate delivery, stays flat or even goes up slightly, UNG can still lose value over time purely because of this cost of rolling into more expensive future contracts.
Wow. So you could be right about the direction of gas prices, but still lose money. That's crucial to understand.
Absolutely crucial. It's probably the single biggest structural risk for long-term holders. And the SEC filings also mention other risks, like relying heavily on derivatives means exposure to counterparty risk, the risk the other side of the futures contract can't pay up, and potential changes in regulations around commodity trading could also impact it.
Okay, those are significant risks baked into the structure. How does UNG stack up against some alternatives? The report mentioned BOIL and XLE.
Right, so BOIL is also natural gas focused, but it's leveraged. It aims to deliver like 2x the daily return of a natural gas index.
So even more volatile than UNG.
Potentially much more volatile, yes. Designed for short-term trading, really.
Mm-hmm.
And XLE is the Energy Select Sector EPF, much broader, holds stocks of big energy companies like ExxonMobil, Chevron, etc.
So very different beasts. How did their recent performance compare year to date?
According to the data we saw, UNG was down about 6.6% year-to-date. BOIL, being leveraged, its performance would amplify whatever natural gas did. So hard to give a single number without knowing the exact period and direction, but expect bigger swings. XLE, the broader energy fund, was down less, somewhere in the -3% to -5% range. More diversified, less direct nat gas exposure.
And the costs, expense ratios.
UNG, we said, is around 0.60%. BOIL, because of the leverage and active management asset involved, is typically higher, maybe 1% to 2%. XLE, being a large, broad-based index ETF, is generally much cheaper, often down the 0.00% to 0.13% range.
Big difference there. And liquidity, you mentioned UNG's AUM is around $379 million versus XLE's $40 billion plus. Does that matter for the average investor?
It can. Lower AUM and lower average daily trading volume for UNG compared to XLA might mean slightly wider bid-ask spreads. So the cost of actually getting in and out of your position could be a bit higher, especially if you're trading large amounts.
Okay. Any recent news or developments to touch on? We mentioned the March 2025 net income figure earlier.
Right. That $27.2 million net income for March. And as of late April 2025, the reports had UNG trading around $15.70 a share, with the market cap matching that AUM of roughly $379 million.
So those numbers just give a snapshot. The main point is its price will keep mirroring natural gas swings and broader market sentiment.
Exactly. And remember, the whole natural gas sector is sensitive to so many external factors.
Global energy demand, geopolitics, weather.
Supply chain issues, regulatory shifts. All of it can inject volatility pretty quickly.
Okay, let's try to summarize. Key red flags or potential downsides.
Number one is that high volatility inherent in natural gas prices. And number two, arguably just as important, is the potential drag on returns in the futures roll process, especially contango.
Got it. And the strengths, the reasons someone might consider it.
Simplicity and access, really. It offers a convenient, liquid, exchange-traded way to get direct exposure to natural gas price movements without having to trade futures contracts yourself.
So it serves a purpose, but it's a specific tool. Looking ahead, what's the outlook depend on?
It's going to continue to be heavily influenced by those natural gas price fluctuations and the dynamics of the futures market, whether it's in contango or backwardation. Any significant regulatory changes impacting natural gas production, transport, or usage could also be major factors.
So you need to keep an eye on the commodity itself, the futures market structure, and the wider energy landscape.
That's the context, yes. Broader market conditions, geopolitical events, supply disruptions, they all feed into the potential volatility here.
Okay, so wrapping this up, what does this all mean for you, the listener? UNG clearly offers a direct path to play natural gas price movements. But, and this is a big but, it's definitely not a traditional stock investment.
The nuances are critical. Understanding how futures contracts work, the specific impact of contango, and just the raw volatility of natural gas, you have to be comfortable with all that.
It's a specific tool for a specific job, and it comes with its own unique set of risks and characteristics. It's not a buy and hold forever kind of asset for most people, likely.
Probably not, given the potential for value erosion from the roll yield over long periods.
If you want to dig deeper yourself, you can check out the fund provider's website. That's www.udcfiinvestments.com. And of course, keep an eye on financial news and the SEC filings for updates.
Always good practice.
We hope this discussion helped you sort of unpack the key things to know about UNG. If you found this insightful, definitely subscribe, give us a like, and maybe leave a comment telling us what other investment vehicles you'd like us to explore.
We'd love to hear from you.